welcome back to a real special show of shows, meaning a show describing what this show is about and why I do it to begin with. First, we covered that I don't even want you to buy an individual stock until you own a diversified index fund and own enough to make it so it's always going to be the biggest part of your savings, never stocks. We don't call the show Mad Money for nothing. We're using Mad Money only to buy stocks. The rest goes into index funds. Next, we learn how not to invest, buying a stock national video ignorantly through a tip from a broker via a brother, and then riding it all the way up and then all the way down.
That was easy.
That wouldn't happen with an index fund, but we respect the right everyone has to try to invest in individual stocks, even as we recognize that my father, had he diversified it into an index fund if they existed back then, or at least a basket of stocks, might have had a lot more to show for it. Which brings me to the second stock object lesson of the night, American agronomics. Initially, when I got out of school, I knocked around as a reporter, covering sports and government in Tallahassee, where I made about $153 a week, and then homicide in L.A., after winning some awards for my coverage of the Ted Bundy murders in the Florida Capitol. I didn't make much money either there, but I knew to open an IRA and to save money. My dad told me to do it. So whatever little money I had automatically went to the Fidelity Magellan Mutual Fund. That was run by Peter Lynch, the best investor of his day. But like my dad, I was determined to try to augment that mutual fund and my paycheck by buying individual stocks for a personal account. However, I was going to do it the right way, by researching the stocks, getting an edge through the research, not through the brother, through the broker, all that stuff. Where was I going to get that edge? I figured, why not read all the periodicals that covered stocks? There were so many of them back then. I was helping to start a magazine called American Lawyer, a trade publication devoted to the profession of law. And because of an ascetic lifestyle and a kind sister let me crash in her studio apartment in the Village for a bit, I was actually able to save some money. In fact, I saved more than $200 beyond my contributions to my IRA and decided to use that definition of mad money to buy the stock of American agronomics. Why? Because I read an article in Forbes magazine, which we got at work. And that article said that this orange grower was doing incredibly well. And I'd be on the ground floor if I bought it. So I picked up 10 shares of this $9 stock. 10 shares. Oh, I was in on the ground floor, all right. You know what ground floor I was in on? I was in on the cheap linoleum ground floor that I ended up sipping that Cuddy Sark on. Yeah, because a frost promptly wiped out the orange crop and destroyed my investment. I should have given up right there. I didn't. I just changed my MO. What I did give up on, though, was the idea of buying a stock off a well-researched article in a good periodical and then letting it ride. It didn't hit me about a better way to do it, though, until I got a call from an old friend of mine, high school friend, who said that a local steel mill, which made precision steel, it's called SPS at that point, was hiring if I was looking for a high-paying job. They had a lot of orders, and they were desperate for workers. Hey, my friend didn't know. You knew that I was struggling for extra money. You knew that I might want another job. Hey, those calls in the middle of a recession from a friend for a job, they can be like gold. But I said, nah, I was happy where I was. But I decided, why not look into SPS and see how it was doing as a company, as a stock? So I went to the Midtown Library in New York, that's where they had all the periodicals, and promptly read up on anything and everything that was SPS, which then changed to ST Technologies. They had everything at that library, business periodicals, value lines, some Wall Street research, even you name it. And here's what I discovered. First, there wasn't much known or written about SPS. And second, what was written was pretty darn negative. My first thought was to say, oh, well, it's not doing that well. Bummer. But then I realized, hold it. My information is the most current possible. I got a guy telling me they can't handle the business they have and need to add additional shifts of unskilled labor like me, but the periodicals all read negatively about it. In other words, I had insight nobody else had. I was ahead of the story. Now, these days, it's hard to get that kind of edge. Everybody pretty much knows everything at once. Edges do exist, though, and we do our best to present them every night. Interpretations of news and events can augment those edges, and analysis is very important. But back then, I had the pure play. I took everything I had, everything I'd saved, and I made a ton of money as the SPS story unfolded. Enough money that I decided I would look around the office for more ideas where I had an edge. I was writing about lawyers who were working on mergers and acquisitions back then, and it was clear, all the public ones. And it was pretty clear that the hot field for M&A was always about oil and gas. One after another, they were being gobbled up. So I figured, geez, why don't I find one that hasn't been gobbled up yet? So back to that library to read about the industry. Sure enough, I found a company called Natomas, which had just discovered a large find in Indonesia. I took another chunk of money. Remember, we were talking about, say, like $300, and bought that stock. I don't think I had to wait very long before I caught another takeover bid. At that point, I was hooked. That changed everything for me. Changed my whole career plans. Yep, I put money into my mutual fund, but anything left went into individual stocks. And I made enough money to pay for my first year of law school when I decided to go back to become an attorney. Now, I know already that there are people out there who will say, wait a second, none of this is possible today. First, the research, which was so scanty back then, is everywhere now, courtesy of the web. Second, anyone can Google any company and know how it's doing in a nanosecond. And you would have known that SPS, which was later taken over at a huge premium by Precision Castparts, which then subsequently got a bid from Berkshire Hathaway, Warren Buffett, was hiring and doing well. Third, there are now rules that make it so it's really hard to get any sort of edge because companies have to have full and fair disclosure of all news or be prosecuted by the government. That means some would say you can't possibly game stocks at all, and you might as well buy an index fund. You know, I am not against that. I was investing in individual stocks right alongside a much bigger percentage of my savings in the best mutual fund at the time. Still, though, I recognize that you can study and you can pick worthwhile stocks that might be doing better than the average stock and that can indeed augment your savings provided you do it right. Have some edge and stay current on the company. So here's the bottom line. Remember American Agronomics and SPS. If you only know what one person says in the media, me or the writer of Forbes or anyone else, and you buy, I am telling you right here, right now, that's not good enough. It's a start. Better to have genuine insight that others might not have, especially if it's against the grain of the consensus. Then you increase the odds of that investment succeeding. It is, in the end, about the odds. And any hard work and thinking you can do to increase those odds in your favor is going to make it more likely than not that you will succeed as a do-it-yourself investor, which in the end should be the exact reason why you watch this show. Joe in New York. Joe.
Booyah, Jim. This is Joe from Kings Park, New York. Thanks for taking my call.
Of course.
Just a quick thank you for sharing your wisdom with your viewers. We most certainly appreciate it. Thank you.
Well, I got a great staff that helps me. Thank you.
My question is this. If I want to diversify and add 3 or 4 companies to my portfolio for the long term, but by diversifying, I would only be able to buy 2 or 3 shares of each company. Or would it be better to buy 10 shares of one of them? And basically, what is the least amount of shares you would invest?
10 shares is, I've done many times. I've owned 10 shares. I've done 2 or 3 shares at various times in my career. Remember, though, I do favor an index fund for your first investments, and only after you've maxed out on index funds would I would suggest that you buy an individual stock. All right, nobody said investing was easy. That's why I come out here every night to help you put the odds in your favor. It requires genuine insight, time, and hard work on your part. But don't worry, you know what? We'll do it together. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.